Oh, right. Today is Wednesday, September 14th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Of course, we're in the aftermath of the shock that we got yesterday, and the market is still in the process of finding its way. It got whacked severely on the head yesterday. The buyers are now shy. The sellers already did a lot of selling yesterday, so the market went up a little bit in the morning, went down again in the afternoon. But the take here is the plunge protection team was busy. Because by the end of the day, the market looked like as it wanted to take another dump, another massive puke. But every time it goes down, mysteriously we see up higher. Somebody places an order. And there was also funny activities in the options market, specifically when it comes to Tesla. We'll cover that in details. But before we do that, I have few notes here. Note number one. Yesterday, when I was talking about the housing market, I mentioned that the key to fixing rent inflation right now is controlling demand. What does that mean? It means unemployment, which is very tragic. A lot of folks got the impression that I'm cheering for unemployment to rise higher.
Some men just want to watch the world burn.
Not at all, but it is inevitable at this point. What I'm actually cheering for is these corporations and so-called real estate investors who in 2020-2021 decided to take a bunch of mortgages and scoop up a lot of single-family homes across the country. And what they did is, at the time when they secured these mortgages, the interest rate was pretty much at zero. So let's say they have a mortgage on a single-family home at about $2,500 a month. What they did is rent this property for $4,000 a month. Or if it happens to be in a desirable location, they list that property on Airbnb and they make more, way more, than what they're paying in mortgage per month. Now, we live in a free society, in a capitalist society, so hey, have at it. But to me personally, I'm against it because you're stealing the American dream just because you can, just because you have the means. In essence, you're destroying the American dream, number one. Number two, you're also participating in pushing inflation higher. So to me personally, I don't want to offend a lot of people here. We have a lot of landlords watching. I get it. But to me personally, there are plenty of ways, more honorable ways to invest and make money besides stealing the American dream. That's just my take. You can agree with it, you can disagree with it. But what I would be cheering for is when these big corporations and big-time landlords get to a point where they cannot charge more than the mortgage they're paying for that property. That is the moment when they realize they cannot rent the property, or they can do it, but they're going to lose money. So what are they going to do? They will get rid of these properties. They're underwater now, not just in terms of the mortgage, but also in terms of the value of the property. And this will increase the supply, and you will see inflation moving down. But the key to that happening would be unemployment, when nobody can afford the rents that these landlords are charging. Again, tragic, but this is the way it's going to happen. And I'm going to cover that in details in a video I'm planning on the real estate market. But this is not the subject for today. Note number two that I got is, when I was talking about Nero yesterday and the fact that Jerome Powell needs to become really aggressive in tackling inflation, and he needs to take charge by grabbing the steering wheel and telling inflation, get back. You're not in charge anymore. I was reminded with the scene from Casino, I don't know if you watched that movie or not, when Joe Pesci's character, Nicky Santoro, stabs the guy with a pen. And then remember the comment that De Niro's character said after that?
You beat Nicky with fists, he comes back with a bat. You beat him with a knife, he comes back with a gun. And if you beat him with a gun, you better kill him, because he'll keep coming back and back until one of you is dead.
This is exactly applicable to inflation. If you hit it with a bat, it's going to come back again stronger. It's going to hit you back with a knife. If you hit it with a knife, it's going to come back bigger and stronger and hit you with a gun. So this pathetic and weak approach by the Fed in fighting inflation is not acceptable anymore, and it's not going to work anymore. It hasn't been working to begin with. The Fed needs to kill inflation. Otherwise, it's going to keep coming back with more aggression. A little more than 40 years ago, Paul Volcker acknowledged that, and he went guns blazing against inflation. And that is the approach that Jerome Powell needs to take. Now, unfortunately, the collateral damage will be severe, and that's that. It is unavoidable at this point, because it's not just inflation rising higher on its own. We have more tailwinds by the day. We know what's going on in Ukraine and the upcoming winter season and what's going to happen there with the energy crisis. But now we have another wrinkle here in this country, and it is related to the railroad strike, which is the main topic of tonight's video. So here it is, in focus tonight. A looming railroad strike that could push inflation higher and paralyze the American economy. You might have heard the news that we have a looming strike in railroads, not just for passenger railroads, but also for freight railroads across the country. And this one would be one of the largest labor union strikes in American history, and the ramification will be severe. Take a look.
Tonight, a looming nationwide railway worker strike could derail the economy's fragile supply chain. President Biden has personally called the unions and the railroad companies to try and reach a deal before the key Friday deadline. Well, CBS's Chris Van Cleve shows us that could cost the U.S. billions of dollars per day.
Tonight, as much as 40% of all U.S. freight shipments could be halted by Friday if the nation's railroads can't make a deal with unions representing nearly 60,000 workers. Negotiations continue as at least 3 cabinet secretaries and President Biden work to end the stalemate.
The shutdown is not acceptable.
The two sides are at odds over sick time and attendance policies unions say penalize workers. The looming strike would idle 7,000 trains and 140,000 miles of track across 49 states, prompting Amtrak to cancel some long-haul service and warnings for commuter rail riders to make backup plans before Friday.
I've been commuting from the suburbs to Chicago now for over 30 years. I can never remember this happening.
Already, freight railroads are refusing some cargo.
There's just no question that it would be extremely devastating. This is sort of one of those things that is a main artery for the entire U.S. economy. And if you cut off that artery, you get a stroke, and you can't afford that.
Nearly 500,000 extra big rigs would be needed to replace the idled trains. The first rail strike in 30 years could cost the economy an estimated $2 billion a day, disrupting agriculture, automotive, energy, and retail businesses.
Now, America's freight rail network extends to 140,000 miles. 1/3 of all U.S. exports take place via railroads. 40% of long-distance freight volume is carried by railroads. We also have a significant volume of imports, specifically from Mexico and Canada, that is also carried via railroads. When it comes to mode of freight transportation in America, rail takes the second place right after trucks, at around $16 billion worth of goods transported via rail. And there is a handful of companies that control the rail network in America. Take a look.
There are 7 major freight railroads that connect North America. Union Pacific and BNSF dominate the West. CSX and Norfolk Southern are the primary East Coast operators, while Kansas City Southern, along with Canadian Pacific and Canadian National, run routes north and south. Amtrak, which is the United States passenger service, owns only 3% of the country's rail. In 2019, the top 5 railroads in the U.S. had a total operating revenue of over $71 billion. BNSF, a subsidiary of Warren Buffett's Berkshire Hathaway, is not publicly traded, but the remaining 4 U.S. companies have seen their stock on a steady climb over the last several years.
Now, these companies have been enjoying massive profits and revenues because they benefit from inflation. They can charge whatever they want. They're transporting important and critical commodities that are rising in price, so the rails have the power to charge whatever they want. At least they had that power until inflation got out of control. So the stocks of these companies performed really good. The financials of these companies performed really good. But did the workers in these companies also enjoy the success from inflation? That's a different story. Because now the clock is ticking. It appears that America's railroad companies will shut down commerce entirely by this upcoming Friday. And of course, the stocks of these companies got damaged, at least today, and they will get damaged even more if the strike indeed takes place. This is a chart of UNP, Union Pacific, a weekly chart, and as you can see, the stock is flirting with breaking an important trend line once and for all. And after that, we could see a free fall in this stock. And other stocks and companies will suffer too, because the top commodities that are transported via rail, number 1, motor vehicles and parts. So you will see companies like GM, Ford, Stellantis all suffering. But most importantly, auto part companies that tend to import and export these auto parts from Canada. One of these names is the ticker MGA for Magna International. This is a weekly chart for the name, and as you can see, the chart is flirting with breaking an important support line at 54. And if the strike takes place, this stock will get damaged tremendously, along with many other auto parts stocks. Now, the importance of America's railroad network is not limited to auto parts. Millions worth of carloads of coal are transported via railroads. Millions of carloads worth of chemicals, plastics, drugs, soaps also transported via railroads. Electronics, home goods, cars, grains, food products, construction material, all transported via rails. The country will become paralyzed if this strike takes place. And the most alarming part is food security. We talked about food inflation in last night's video. Stunning numbers. And expect food inflation to rise significantly higher if this strike takes place. Why? You see, all the minerals and materials that are processed to produce fertilizers, they come from Canada or the northern part of the United States, and they're transported via railroads. And after these fertilizers are produced, they're also being transported via railroads to farmers. Once the farmers use these fertilizers to grow crops, guess who transports these crops to distribution centers? The answer is railroads. So this could impact things beyond commodities. Things like produce, breads, meats, even beer and gasoline prices. This is a major event from a commercial perspective, from an economic perspective. And listen to this. This is absolutely alarming. One rail car can transport enough wheat to produce 258,000 loaves of bread. One rail car can transport enough corn to produce 480,000 bags of Fritos. One rail car can transport enough soybeans to produce 415,000 pounds worth of tofu. One rail car can transport enough barley to produce 94,000 gallons worth of beer. A lot of products, folks, that you and me use on an everyday basis will be impacted by this strike. So what are these labor unions and workers for these railroad companies want? I'm going to read from Gizmodo. Remember, Biden has till midnight tomorrow to get a deal. And if he doesn't secure a deal by then, the strike will proceed. It will be one of the most damaging events recently when it comes to inflation and paralyzing the economy. Rail workers could be going on strike soon for the first time in nearly 30 years, which could result in enormous impacts on the wider economy and supply chains. In a release posted midday Wednesday, the International Association of Machinists and Aerospace Workers, AIM, said 49 members of the District 19 voted to reject the tentative agreement they had hashed out with the National Carriers Conference Committee, alongside a board first appointed by the White House in August. Negotiation failed after a closed-door meeting at the Department of Labor headquarters in Washington. There is a so-called cooling-off period, quote-unquote, limiting union strikes while these negotiations go on, but that is set to end at midnight Friday. Fried rail workers and the IAM union put an extension on that ratification process until September 29 at 12 p.m. But there's a problem. Here it is. But there is far more at stake than little under 5,000 railroad staff going without a contract. Listen to this. After Thursday, over 100,000 unionized workers on the railroad who have not linked agreement with carriers will be legally able to strike all the live-long day. The Association of American Railroads told CNBC they had no plans to lock out workers Friday should negotiations not be successfully completed. And why are they upset? They're upset because of this. Fried workers report having to come into work at a moment's notice, making it near impossible to schedule anything or attend something as simple as their own birthday party. Under the Railway Labor Act, workers are only guaranteed 10 hours off every 24 hours and can expect to effectively be on call all day, every day. Considering the average 9 to 5ers is often allowed 16 hours off every 24 hours, it is easy to see why railroad workers are drawing the line in the sand. And by the way, railroad companies cannot just replace these workers as they please. They have contracts with the unions, number one. Number two, even if they want to hire more employees, well, guess what? They have to pay higher wages at that point. Either way, they're completely screwed. Matter of fact, 8 of 12 railroad unions had reached tentative deals with the companies as of Wednesday, but other groups are still talking to carriers, including the two biggest freight railroad workers unions, BLAT and SMART Transportation Divisions. A strike at this point would likely impact already straining U.S. supply chains and cause other knock-on effects within the transportation sector like Amtrak. The original agreement included 24% raises and back pay but did not address calls for more standardized hours and the ability to take necessary time off for events like doctor's appointments without being penalized. It's reasonable, isn't it? The IAM represents members of fried rail workers as well as people in the motorcycle manufacturing and aerospace businesses. Listen to this, totaling nearly 600,000 members, one of the strongest unions in the United States. They were one of the first unions to reach an initial agreement with the railroads, but now that they're pulling back, it could change the balance of power between the carriers and the Biden administration versus the unions. It would also likely mean affiliated members would be incentivized to not cross the picket line, which could prove a problem for companies like Boeing and Lockheed Martin, who have workers in the IAM. Now, folks, let's cross our fingers and hope that we're going to have a deal by tomorrow. The problem is it doesn't look likely right now. Something major has to happen. Major compromise by the railroads. Now, if they compromise, their margins will go down big. If they don't compromise, there is also a chance that this strike could be contagious. You've heard that these unions also represent machinists, aerospace workers. What if they all collaborate and strike altogether? That would be devastating for this economy. And on top of that, it would be devastating when it comes to inflation. It will push inflation significantly higher. If I put 2 and 2 together, we have an election coming up in November. The likelihood is the Biden administration will bend over backwards in an attempt to please these unions. Whether the union's gonna agree or not, that's a different story. If we have a deal, you will see the stock market blasting higher on the optimism alone, specifically these railroad company stocks. But if they don't get to a deal, you will see a major sell-off, not just in the names that are presented to you, but across the stock market too, because the damage will not be limited to railroads or auto part companies or commodities importers. The rise in inflation alone will punish all of these companies, all of these stocks, and the entire economy. You're already seeing the prices of commodities surging higher, despite the rise in the US dollar. And the reason is, when you paralyze the economy, when these commodities are not moving across the country, the supply shrinks. The demand is still too hot. You put 2 and 2 together, we have more inflation. So this is just another piece of evidence that is devastating to the peak inflation crowd. Yesterday, they got a smack on the face by the CPI. Now they're about to get another massive smack on the mouth. What does that mean? It means that the Fed, with the only tool they got left, controlling demand, they have to act even more aggressively in tightening the monetary policy and destroying demand in the economy. And at some point, they're going to have no choice but to intentionally push this economy into a recession, perhaps a prolonged recession, to resolve the inflation problem. We're not through yet, folks. The final episode is about to start, and the majority of action will take place in the final episode. But until then, we have to move on and cover the stock market for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average was up by 30.12 points, or a gain of 0.10%. The Nasdaq also in the green by 86.10 points, or a gain of 0.74%. The S&P 500 also in the green by 13.32 points, or a gain of 0.34%. Today was the reflex from yesterday's massive drop. The market went up, went down, and finally finished in the green, but nothing is conclusive yet. When it comes to the sector's performances today, at number 1, capturing the gold medal, energy. Number 2 for the silver, cyclicals. Number 3 for the bronze, utilities. The laggards of the day led by real estate and materials. The advance to decline ratios, NYSE 48% advancing versus 49% declining. And despite the positive closing for the Nasdaq, the breadth was not so hot so. Only 45% advancing versus 51% declining. Moving on to commodities. Today, the dollar was down by a little bit. It lost about half a percentage point. The yen was higher, so it added a little bit of pressure on the dollar, and expectations that the Japanese central bank will indeed maybe raise rates or do something to shore up the yen. But the problem is, it appears that energy commodities, specifically crude, are bottoming. Today, both the WTI and Brent scored gains, the WTI leading with gains of about 2%, Brent with gains of a little over 1.5%. The gasoline RBOB rebounded higher, and it gained a little over 2% for the day. On the other hand, heating oil was down by about 4%, yet the party boy, natural gas, with massive gains of almost 10% in a single day. Natural gas will be the story of inflation this coming winter. I remain a bull on natural gas, and my pick is the ticker CTRA Coterra. I made a video about it before. It has the cleanest fundamentals, and the valuation is absurd. But you have other good names like Cheniere, the ticker LNG, the ticker ticker EQT. We covered plenty of names before. All of them are good, but again, you gotta do the fundamental analysis and pick your pick. But natural gas, that is one corner of the stock market that I remain bullish on. Another one is uranium. Unfortunately, we don't have a lot of picks in the stock market besides the ETF URA and another name that I'm going to discuss with you in the options market. We have a trade for it, but everybody talks about peak inflation when it comes to commodities. Well, peak inflation is not happening in this commodity. Yellow cake, uranium, is actually surging higher. And the reason is, now that we have the tensions in Europe and the possibility of zero natural gas flows from Russia, a lot of these European countries will depend on uranium. Yellow cake is one component to power these nuclear facilities. So we're seeing the prices surging higher. The expectations are the demand for yellow cake and uranium will also rise higher. Back to the futures. Softs, they were soft again, led by lumber with losses of almost 4% for the day. Coffee down a little over 2.25%. Cocoa down a little over 1.5% for the day, with modest declines for OJ and sugar futures. The only winner today was cotton futures, closing with modest gains for the day. Metals, mixed picture here. We have a rebound in palladium and platinum as the dollar goes down. Likewise, modest gain for silver futures, but the most dollar-sensitive commodities, gold and copper, were down. Copper was down a little over 1%. Copper was the trade to be long at had the CPI came out cooler than expectations and the dollar went down big. Copper would have performed pretty good, but the opposite happened once the CPI came out too hot. What about meats? Muted action for both live and feeder cattle futures, be it live cattle in the red, feeder cattle in the green. And the new big tech lean hogs, well, it is a down day for around 1% for this commodity. When it comes to grains, the winner is wheat futures with gains of about 1.5% today. The rest muted, rough rice, canola, soybean meal, all muted for the day. But we have decliners, led by soybean oil down a little over 2% for the day, followed by corn, soybean, oats, all closing in the red. Moving on to the big casino, the options market. What's going on here? The volume all in all went down, but it went higher for one name, which came up number one, Tesla, at around 2.2 million contracts traded today. Around 51% of those were calls. We have some manipulation that took place today. More on that in a second, but at number two, Apple, at around 1.6 million contracts traded today. Around 50% of those were calls. We're seeing more and more bearish bets against Apple. We'll talk about that in the charts analysis. But at number three, Meta, at around 870,000 contracts traded today. Look at this. Only 38.5% of those were calls. They're buying a lot of puts against Meta. Now, here's the piece regarding Tesla. Why was Tesla an outperformer for the day? We saw massive call option buying for the 300, 305, 310 calls with the expiration date of this Friday. In other words, somebody's manipulating the stock higher by buying these contracts in and out to force a gamma squeeze, to deceive the dealer into buying the underlying stock Tesla to push it higher. They get in, they get out in the same day or within 2 days or 3, and they make a quick gain, big time kind of gains. Look at the options grid. They bought the 300. You see, the open interest is not this large at all, meaning they're not holding the contracts. They have no conviction that Tesla will indeed move higher by the end of the week. And when we look for next week's options grid, crickets, nothing, meaning this is a forced gamma squeeze. A large whale type of trader is playing this game. They stampede in buying the 300 calls out of the money, forcing the dealer to buy Tesla. Then they close these contracts, and therefore you see the volume way too large compared to the open interest. And then they roll these profits and they buy the 305 contract, and they make a quick gain out of that. They close these contracts, they move the profits to the 310. And as the stock continues to move higher because the dealer is buying, they continue to make money. But at some point, they know that the stock might not make it to 310. They close these contracts and they bail out. And comes Friday, the dealer looks around, the contract's already closed, nobody's holding open interest at all, they dump shares of Tesla. But in the process of this fake gamma squeeze, a lot of retail mom and pop investors are deceived and they jump on the rally in buying Tesla shares, only to be flushed down once this manufactured gamma squeeze is done. And this has been going on, folks, for years. I call it Tesla whale, the trader. And it is a large type kind of whale. Somebody extremely powerful with a lot of money is behind this squeeze. Now, let's move on to the unusual activities that took place in the options market today. We start with the ticker SPY for the S&P 500. Somebody's buying calls here On the other hand, somebody is selling those calls to raise some cash. But from the buyer's perspective, they see more upside for the SPY, a rebound, but it is unrealistic right now. And therefore, my hunch is somebody sold these contracts to raise cash. Somebody holds the SPY, sold these covered contracts to raise cash. But anyhow, somebody has to buy them. So the buyer bought the 425 calls for the expiration date, October 28th, with expectations that the SPY could rally higher and gain over 8% by then. They paid around $2 a piece to enter this trade, all in all spending around $3 million. At the bottom of the table, what about the ticker SBUX Starbucks? A lot of pumping has been done in the last 2 weeks in Starbucks. Schultz was out, they have their investors day, and they're panicking, of course, because the company spent a lot of cash in the last quarter and they're running out of cash for such a large company. Somebody sees the sham and they're betting against Starbucks. They bought the 85 puts for the expiration date, September 30th, with expectations that the name could move down and lose more than 8% of its value by then. They paid around $0.50 a piece to enter this trade, all in all spending around $300,000. Continuing with interesting trades, what about the spread for the SPY? This time around it's a put spread. They bought the 372 puts and they sold the 340. All for the expiration date October 14th, with expectations that the SPY could go down and lose more than 6% of its value by then, but not more than 14%. They paid around $4 a piece for buying the 372 puts, and they received in credit around $1 a piece from selling the 340 puts. All in all, the entry cost is reduced to around $3 a piece, and the total comes to $1.2 million. What about the triple Qs, the Nasdaq? Somebody sees more downside here and they bought the 255 puts for the expiration date October 14th, with expectations that the Qs could lose more than 14% of its value by then. They paid around $1.40 a piece to enter this trade, all in all spending around $500,000. And lastly, here it is. You want to talk uranium? The ticker CCJ, an impressive outperformer for the year, and somebody sees more gains to come. They bought the 32 calls for the expiration date, October 7th, with expectations that the name could move higher and gain more than 5% by then. They paid around $1.20 a piece to enter this trade, all in all spending around $500,000. Moving on to the heat map analysis, what's going on here? You're seeing the reflex right before your eyes. Yesterday was a sea of red, now we're seeing some short covering in certain names, meaning profit taking, but as we see these names moving higher, we will also see more sellers and more shorting. But for now, the names that led the rebound, you got Apple, a big rebound, chips, certain names in software such as Snowflake, Uber were outperformers for the day. In communication services, we have T-Mobile and Comcast all bouncing higher. Netflix, we'll talk about the news behind Netflix in a second, but Tesla was an outperformer. We talked about the gamma squeeze in the options market. The travel names also rebounded higher. Starbucks gained a lot today, over 5%, on the heels of the Investors Day and the fake news that came out. But we have more negative news coming for Starbucks. I'll talk about that in a second. Another corner that outperformed today in industrials is the defense contractors. The tailwinds for these companies are still intact with the Ukraine war. Utilities was an outperformer today. And obviously, natural gas, oil, these names were outperforming today big time. In materials, agricultural stocks also outperformed. Of course, they're bouncing from massive losses earlier this week, as the looming strike in railroads could damage their business tremendously. Now, the underperformers, the obvious is steel, copper, all of these metals underperformed, and the reason is the disappointing CPI is likely to push the dollar higher. On top of that, the railroad strike also will impact a lot of these materials. Real estate was an underperformer, and the reason is yields continue to move higher. Of course, the railroads, the ticker UNP for Union Pacific in industrials was down big, along with other railroad stocks. Some pockets in healthcare underperformed today, and in technology, the ticker ORCL Oracle was down big, but that is on the heel of earnings yesterday. Now, can the reflex continue for a day or two? The answer is yes. We have a lot of activities about to happen in quad witching on Friday. If they go higher again on Thursday, tomorrow, in all likelihood Friday they'll go down. Because remember, right now the dealer is looking for the points of maximum pain, and they want to make the contracts being held by call options holders and put options holders expire worthless. So they're going to move the market one way or the other. They're going to attempt at least to move the market one way or the other to the point of maximum pain, with the majority of call options and the majority of put options expire worthless. We'll talk about that in tomorrow's video. But let's do some corporate news here. We start with Starbucks. Starbucks announced a new set of benefits for their employees. The problem is we have a catch, and the catch is all of these stores that unionized, they will be excluded from the new financial package. So this is yet another attempt by Starbucks to discourage unions and, matter of fact, punish them. We also have some more bad news for Starbucks, but not really, because the manufacturer of these Starbucks energy drinks is actually PepsiCo. And PepsiCo has recalled the pre-packaged Starbucks branded espresso drinks due to possible contamination from metal fragments. So if you have the habit of buying these drinks, you might want to hold on a little bit, unless you have some aluminum deficiency. Anyways, what about Twitter? Everybody's talking about the whistleblower. Is this good? Is this bad? First of all, it exposes things that we already knew about Twitter. We know that Twitter is full of scams and full of operatives on behalf of foreign governments, in this case China, India. The whistleblower exposed all of that. But what the whistleblower did not expose is how the deep state in this country also infiltrated Twitter. The intelligence apparatus up Uranus, they're all over Twitter. And their goal, of course, is to suppress speech. But that part they're not going to tell you. Now, does this strengthen the case for Elon Musk versus Twitter? The answer is yes. But it's not going to change the outcome. It only makes the possibility of the outcome of forcing Elon Musk to buy Twitter out of the question. So in all likelihood, the judge is not going to force Elon to buy Twitter. But the part of punishing Elon by a massive fine, multi-billion dollars worth of fine, that's going to happen regardless of the whistleblower. And then we have Patreon. It's not listed in the stock market, but Patreon is letting go of about 17% of its staff in Europe. So we're seeing more layoffs in these technology companies. And here's the news regarding Netflix. We have some optimism because Netflix got out some fake news that their ad-supported tier will reach 40 million viewers. Here's the problem. What is the cannibalization effect? Because if you're going to open a free tier with ads, a lot of folks will downgrade. They're not going to become paying members. And is the exchange worth it? Is Netflix about to make more money from selling ads versus selling memberships? That is one thing to think about. Another thing is, specifically overseas, wait till some Bulgarian hackers figure out a way to disable ads on Netflix, and then everybody gets it for free. Oh yeah. You think this is good news for the company? Think again. And then we got news for Amazon. This is devastating. The state of California is suing Amazon, aka the evil empire, for alleged antitrust violations that inflated prices. It represents Amazon's biggest legal challenge in the US to date. The reason is Amazon owns the politicians, the judges, and even the president. So nothing happens to them, even though it is a clear monopoly. It is destroying the fabric of this country, small businesses. But that doesn't matter because they own everybody in the government. But perhaps they forgot to pay some California politicians. And now the politicians are saying, hey, Amazon, where's my taste? You want us to get rid of this case? Show us the money. And lastly, more corruption news for you. Tesla is now pausing its plans to make batteries in Germany. Why? Because they're going to make them here in the United States to qualify for tax credits. More freeloading, more handouts to the biggest corporations in America. This is a multi-billion dollars company. It is worth over $700 billion. Yet somehow we have to give them more handouts. And of course, Elon Musk will take the handouts. He has no problem. He's been doing this since the company began. Without the generosity of the taxpayer, or should I say the robbery of the taxpayer, Tesla would have never been possible. So all of you morons and sheepies who are cheering for the so-called Inflation Reduction Act, the Inflation Reduction Act doesn't reduce shit. It only reduces your quality of life. And it is designed to rob the taxpayer and transfer all of that money to the biggest corporations in America to save the planet. You see how this scam works? Anyhow, moving on to the ETFs heat map. What's going on here? Muted. Maybe the stocks ETFs is not showing the reflex reaction, but this one does. It's only a reflex reaction. That's all there is. Yes, growth outperformed value, but it only did that because yesterday growth underperformed value by a lot. But everything was pretty much muted for the day. You got energy commodities, you got energy ETFs, XOP, XLE outperforming by a lot, and then you have the underperformer, the XME, down big in metals metals, materials, real estate ETFs down big, but that's about it. The outperformers mostly in commodities, not just in the OIH, for example, for oil and gas, but if we zoom in, even URA for uranium outperformed today. When it comes to international, the outperformers came from the EWJ in Japan, the yen was higher today, and India continues to outperform the ticker INDA. But besides that, it is just a mere reflex. They might build on these gains tomorrow, but sooner or later they're going down. Maybe commodities, specifically energy, will sustain the gains, but besides that, it's really hard to see. Let's move on to charts, and we start with the SPY, the S&P 500 30-minute chart. What's going on here? We got gains right away, right off the door in the morning, and the gains continued to build on until the afternoon when the flush down started. Why? What is the psychological explanation behind that? The answer is a lot of folks who made a lot of money from shorting yesterday, they booked their profits right away in the morning, at least some of the profits. And then as these stocks and the indices moved higher, more sellers came and more shorting took place. But the indices at least did not lose critical support levels. Plunge protection team, whoever was behind holding those support lines, they did a pretty good job today. Because for the SPY, the support of 391 remains intact, and now they got support at 393.16. The momentum indicators remain oversold, at least for now, so we could see more gains to come. That could take us all the way to 398. It could take us all the way to 400. But by then, the oversold conditions will be resolved, and the main theme of bearishness will be resumed. Now, this could happen right off the gate tomorrow, but I'm just telling you that there is a possibility of more gains to come. And the reason is the oversold conditions. Here's the daily chart for the continuous contract for the S&P 500. While the 30-minute chart shows the possibility of more gains to come based on oversold conditions, the daily chart says not really. So whatever pops you're going to see, they're going to be short-lived because the daily chart remains negative. Yes, the chart is holding the trend line. This is good news for the bulls. The last good news left. Yes, they're holding at 3,960, but they could lose that right away tomorrow. They need to build on more gains and get the chart at least above half of the body of the flush down candle to have any hope of reversing this bearish trend. Because we look at the MACD, the RSI, they're still curling their way to the downside, indicating more pain to come. The Qs, 30-minute chart, what's going on here? Similar story with SPY, gains right off the gate in the morning, but by the afternoon, they flushed them down right away. Yet the plunge came out by the end of the day and reaffirmed the support at 294.33. We now have what it appears to be a double bottom, indicating we could see more gains to come. We could see gains all the way to the trend line in yellow. We could see gains all the way to 300.72, but by then, the oversold conditions will be resolved. And the bearishness, the assumption at least for now, the bearishness will resume. So a lot of you who are holding put options with the expiration date of Friday, you're going to be a little nervous here, specifically if the chart continues to move higher tomorrow. And therefore, you should have booked some gains or at least rolled all the way till October, expiration date. Leaving yourself with 2 days till expiration, bad strategy because there are mechanical reasons behind the reflex. Moving on to the daily chart for the continuous contract for the NASDAQ. Once again, unlike the 30-minute chart, which shows some hope for the bulls, the daily doesn't, at least not for now. Yes, the support of 12,207 is intact for now, but it could be lost right away off the gate tomorrow. And then the next support would be 11,689, and after that, the June bottom. For now, the momentum indicators remain negative. The RSI, the MACD, the volume still above average, favoring more selling to come. So whatever bounces we get in the short-term charts, such as the 30-minute chart, will be short-lived until we see more repair done in the daily chart. And by repair, I mean closing the week above half of the body of the pain candle. And even if they do that, they have a long way to go to be out of the woods. Here's the IWM 30-minute chart. What's going on here? Nothing happened. Within range, the support remains 178.60 and the resistance at around 183.25. You look at the MACD, you look at the RSI, there is a possibility after making higher lows today that the IWM could move higher and regain 183.25. But for now, the gains will not be sustainable until they do more repair work. And by that, I mean moving all the way to recapture 188 as support once again, perhaps closing the gap. But even if that happens, the bulls are not out of the woods. And the reason is we have the FOMC next week, and Jerome Powell could slaughter them again. Here's the Dixie daily chart. You look at the RSI, the MACD in negative divergence. But how is the chart so far solving the negative impressions in both the RSI and the MACD. We talked about 3 ways the bullish momentum could turn into bearish momentum. The worst way is a flush down, when we see the crossing in the MACD. Another way is a pullback. And the third, the most bullish one, is consolidation. For now, which one is taking place in the dollar chart? The answer is consolidation. So the dollar bulls have the advantage, at least for now, until we see an acceleration in the negative momentum in the MACD and the RSI. We see big flush down candles. This has yet to happen in the dollar, and therefore the bulls have the advantage. And this is adding more downward pressure on gold. If the pressure continues, gold will break the important support of 1,685, and after that, it's about to get really ugly for gold. So the gold bugs better defend 1,685 with all they got. And here is Brent oil, a daily chart. It appears that oil wants to crack above the negative momentum, the negative trend that you see in yellow. It appears this time around that oil will be successful if it does. It is just a matter of time. You look at the momentum indicators, the RSI, the MACD, all firming up, indicating that the technical setup is ready for oil to move higher. And here's the 10-year yield. It appears that the 10-year is weakening, and it is topping from a momentum indicator's perspective. The RSI, the MACD, all overextended and ready to go down. But before you celebrate and say this is good for the NASDAQ and the RKK type of names because yields are going down, forget about the 10-year. No love for the 10-year right now. All eyes are fixated on the 2-year yield. Why? Because it is in the shorter end of the yield curve, and the 2-year continues to explode higher, further increasing the inversion in the yield curve, which means if the trend continues, the yield curve is saying this upcoming recession will be severe. So yes, you could see the 10-year moving down, but technology stocks, the NASDAQ, also getting hit hard. You might be confused. What's going on here? The folks at CNBC and the media said when the 10-year goes higher, it's bad for technology. When it goes down, it's good for technology. It's not as simple as that. You gotta watch the 2-year from this point on. If the 2-year goes down, that's good for technology. But if it continues to move higher, it's not good. And you might even see a more interesting phenomenon where the 2-year is moving higher while the TLT is also moving higher, yet equities are underperforming. Why? Because of the inversion of the yield curve. The 10-year yield is weakening, the 2-year yield is strengthening, and this could push the TLT higher. This is a weekly chart for the TLT. It is firming up by a little bit, but we need to see more. We need to see at least 109.5 recaptured at support. Here's the VIX 4 hours chart. What's going on here? For now, the consolidation is a bull flag consolidation, indicating more gains to come for the VIX. This outlook goes out of the window if the VIX goes down and closes below half of the body of the breakout candle, which would be at around 24.29, which happens to be a support line. But for now, the outlook is more gains to come for the VIX, which means more pain to come for the SPY. Here's Apple, a daily chart. What's going on here? We got the reflex. Apple made it all the way to 157, but it did not close the day above that number. One way to look at it is this is a bearish outcome. Apple should have at least closed above 157. It did not. It couldn't make it. So now it has to go down and seek support from 150. But we know from the options grid that 150 is a point of pain. If Apple goes down, let's say by tomorrow, the dealer has to scramble and dump Apple shares, which could accelerate the momentum to the downside. So Apple bulls must climb 157 by tomorrow. Because look at this. The headline reads, Tesla spent 864 days as Wall Street's biggest short bet. Now it's Apple. A total of more than $18 billion is bet against the iPhone maker, overtaking longtime leader Tesla for the first time since April 2020. Now, understand this. These short bettors are not stupid. They know that Apple is a red line. You don't short Apple unless you're 100% sure that Apple will go down. Because who's in their right mind will short Apple? The big kahuna, the most important stock in the market, by default, has to go higher every single day. Because every day flows from pension funds, retirement funds, hedge funds, buy ETFs. The largest component of any ETF, at least the major ones, is Apple. So betting against Apple is a dangerous game. Yet when we see conviction in the bets against Apple, it gets really scary. They know something. Apple is the last block to fall. Along with this one, Tesla, an hourly chart. Now Tesla was higher today and the bulls recaptured 298 as support. We're now eyeing a possibility of an ABC pattern that could take us all the way to the highs. But hold your horses here before you get sucked in. What is the reason behind the pop that we got today? The answer is a mechanical reason, and that is the gamma squeeze in the options market. What is the expiration date on the gamma squeeze? The answer is September 16th, meaning this upcoming Friday. So before you get sucked in by the rally, understand this. Those behind the gamma squeeze could dump tomorrow, could dump by Friday. And if they don't roll over and up to next week in October, in all likelihood, the gamma squeeze will frizzle out and we will see Tesla going down again. What about tulips, BTC, Bitcoin, 4 hours chart? What's going on here? It did catch support from the neutral line, the center of gravity at around 20,000. Is it going to hold? That's a different story. We cannot say one way or the other. We need to see conviction in the move. We need to see a move combined with a fundamental source. Let's say a move to the downside combined with the Fed being too aggressive, hiking rates by 100 basis points. Then we have conviction in the move to the downside. Let's say a pop to the upside combined with fundamental news, such as a large type institution buying Bitcoin. Then we have conviction in the move to the upside. Otherwise, if you get sucked in by these pops up or down, you might suffer tremendously. Leave it alone for now. And this leads me to the question by the viewer regarding MicroStrategy, the ticker MSTR. The viewer holds a number of puts against the name, betting that the name will go down. Now here's the problem. The opportunity to short MicroStrategy was in 2021, when everybody was indulged in the mania. Yours truly, the guy you're listening to right now, was shorting stocks back then, when everybody told me, hey Maverick, you're going to regret it. You're going to lose a lot of money. Stop shorting these stocks. But that was exactly the time to short these stocks. Now, look at this. The stock went down from around $1,500 a share to only $225. So the majority of the opportunity in shorting the name is already behind us. You might squeeze in a bunch of gains, let's say 10%, 25% to the downside from this point on. But what is your reasoning? Your reasoning at this point should be Bitcoin crashing to 10,000 or let's say below 15,000, and this will cause MicroStrategy to go bankrupt. Now, remember, you're not shorting the name, you're shorting it via put options. So you have a time limit. So what I'm going to tell you is the following. Grab a pen and paper and draw the timeline from today till expiration date and ask a few questions. Number 1, will Bitcoin crash by that expiration date? Number 2, what would be the fundamental reason behind the crash in Bitcoin? And is it going to happen before that expiration date? Now remember, 3 things move stocks up or down. Number 1, the fundamentals. Number 2, the technicals. Number 3, the mechanics. So what would be the technical reason for the stock to go down? Because right now, the bulls would argue we're seeing a higher low, meaning the worst is behind us. The bears would argue this is yet another bear flag pattern. We have lower lows to come. If you are in the camp of bears, ask yourself a question. Will the bear flag play out by the expiration date that you have right now? When it comes to the mechanics, what are you looking for? You're looking for an increase in bets, buying puts against MicroStrategy. Is that going to happen by the expiration date that you have right now in your contracts? Answer these questions, and if you're convinced with the answers and the expiration date, then you're good to go. But if you have doubt and your thesis is shaky and it might not materialize by the expiration date, then either you want to extend the expiration date or get out of the trade entirely. Or perhaps you can have a better timing. Now let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? In the US, we have retail sales month over month. We also have retail sales in Great Britain. And on top of that, from China, we have industrial production. This will happen overnight, so you'll know the news by the morning. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.